Hello, hello, welcome, welcome. Hope I wish all you guys very well today. We got a lot of stuff to cover, so let me just dive in real quick. All right, thank you so much. So there we go. Let me just. Last time when I did this, I made a small mistake. Hopefully, this time I will control better the screens and the apparatus. Not so used to it, but hopefully this time will work better. All right. Well, good evening. Thanks for coming. Let's get started. All right. So just as we start, um, well, just one thing. If you guys are not hearing me, let me know. All right. This one variable I can't control over here. Okay. So, okay, just a quick recap of our performance so far. Um, you know, strategy 6 and 7, pretty much doing really well. Um, the the volatility strategies have been lagging behind a bit. We made a few adjustments last time. Hopefully, it will work a little better. Okay, but of course, the volatility based strategies, they're more more complex, a little bit more complex and riskier. So it's kind of expected that this kind of thing may happen. All right. And yeah, so this is pretty much what I wanted to show about this. All right, so just to reemphasize, right, what's the goal of our meetings, this club, right? Is to empower investors to accelerate wealth growth through education, by maximizing the return to risk ratio and outperforming the S&P 500 every year. Okay, so that's our goal, and we'll strive by this objective, especially through education. So today we're going to talk about the modern portfolio theory and also correlation, because that's what powers the portfolio theory, right? So there's a saying in finance that's, the free lunch. Diversification can reduce risk without necessarily sacrificing returns. Let's examine this a little bit further and see if this is really true, or in which situations it's true, in which it's not. And so the financial industry, uh, you know, embraced it completely, right? Especially, when we construct our portfolios, we have to assume that the correlation is going to hold, right? And you know, the central tenet of modern portfolio theory is centered on diversification to reduce risk. And it works when assets are uncorrelated or the correlation is negative. Um, Correlation, for those who might not know, it measures how assets move together. Low or negative correlation reduces the portfolio volatility. So that's the goal, right? And so we assume that that correlation is going to be low and stable, right? So that's what's going to give us the diversification that we seek, for lower risk and a better return. Okay, more stable returns. All right, so examples of those, the traditional 60/40, right? And also this is very popular these days, target date funds, for folks at different ages, so they can dynamically change, but over time, the allocation to stocks and bonds, right? This is very common nowadays. And there's also this famous all-weather portfolio popularized by Ray Dalio. They all need correlation to work for them to deliver what they propose. And of course, your portfolio, my portfolio, right? When we build our portfolios, uh, we do the same, basically, right? When the allocation may change, and the assets we choose may change, but that's the idea. Okay, so how asset correlation works? Correlation ranges from -1 to +1. +1 positive correlations mean that the assets move together, asset prices move together. A -1 mean that they move in opposite directions, and 0 means no relationship. But so ideally we want 0 or minus, right? A negative correlation. Those are the ideal, right? If it's slightly positive, it's still okay. It's not ideal. Means that the hedge is not as great as we would like to be, but it's sometimes still works. All right. So here comes problem number one, right? Most assets have positive correlation with the S&P 500. Um, Intuitively, we can understand this because everything is in the same environment. If the economy is growing or is not growing, the S&P 500 will follow, and the other assets more or less they are also influenced. Then it's not the same degree, but they're also influenced, and usually they will have a positive correlation. But we'll go into more detail. So historically, we know that, for example, these asset classes that are typically used to hedge stocks, right? You can use international stocks. The correlation 0.5 to 0.6. During crisis, it will increase. We're going to talk about this as well. That correlation is not fixed. It changes, it varies. And especially during crisis, they're going to, their behavior is not the one that we expect. All right. Fixed income, 0.1 from slightly negative to 0.3 plus, right? So it's okay. As I said, it's not a perfect hedge. It's not exactly what we wanted, but still is acceptable in most cases. Gold. What about gold? Gold is pretty stable, pretty low and pretty stable. Not negative, but also it's close to 0. So it's not that bad. Commodities, of course, it's mixed because depend on what kind of commodity we're talking about. Could be oil, could be silver, copper, whatever, right? So, but correlation is slightly positive. All right. So, do we have a clear winner here, or some asset class that's ideal? Not so much. Maybe gold's a little better. Okay. All right. So why, right? International stocks. Let's try to explain it, right? See what's the reason behind it, right? International stocks tend to rise and fall together because of globalization, right? Especially during crashes and bear markets. That's the famous crisis contagion, right? So sometimes you're hedging U.S. stocks with some other country. I don't know. Right now, people may think, well, we are going to, a lot of money is flowing from U.S. stocks to European stocks. Maybe not, but it there's a lot of other factors under this. For bonds, it's a classic diversification is pairing with stocks, right? But there's a problem. It tends to fail in high inflationary environments and during transition periods between non-inflationary to low inflationary to high inflationary, basically, right? Rising interest rates and inflation will hurt bond prices and equities at the same time. That's pretty much the reason why the correlations, in those environments will tend to be very positive. So that's a problem. Okay. Gold usually is stable and used for safe haven purposes, but tends to underperform in stable rising equity markets. Right, this is not a surprise to anyone. And commodities, of course, a mixed bag. Sometimes work because the commodity cycles might not be exactly aligned with equity markets. So those are pretty much the general reasons why we see correlation numbers such as those we showed in the previous slide. Okay, so here's bonds and stocks, right? So if we look over time, this is since 1945, we saw periods in which we had a positive relationship, right? Positive correlation between stocks and bonds. They're moving together, so it's not really hedging one each other. But in other periods, especially here in the early 2000s, we had a negative correlation, which is great, right? But in 2022, we saw that change again, right? So right now it's positive. Okay, so it's bonds are not hedging stocks right now. Um, and one of the drivers, as we just saw, is inflation, right? So that was the period, the early 2000s is a period of low inflations, right? So that's why we got the negative correlation. But as inflation rose, um, we've seen the correlation between stocks and bonds uh, become positive. All right, so that's a problem. Uh, Also here, so here's a 2 by 2 table to show inflation, the effect of inflation and growth, right? GDP growth, if you're accelerating growth or decelerating growth, and what happens with the correlation. Okay, so you know, you as you can see, in some instances, we have a better or worse situation for the correlation. Here's another view. This is we are trying to relate now the correlation with interest rates, basically. So here's um, the the black line is the U.S. Treasury yield, 10-year yield, and the orange line is the stock bond correlation. You see that they pretty much move in sync, right? So you see, so another reason to show you guys that the correlation is not a fixed number. In our models, our assumptions, we often use a fixed number, but it changes. All right. So correlation is not constant. That's problem number two. And a worse problem is all correlations tend to go to one plus one in a crisis, right? So the stable correlation assumption is flawed generally. Most assets are positively correlated to stocks. Just saw that. Diversification can disappear when you need it most, right? In a crisis, in a crash, in a bear market, is exactly when you need it to work. If it goes away, exactly when you need it. That's this saying, right? They give you an umbrella when it's sunny, but it's gone when it starts to rain. So that's a problem. Um, Upside diversification and downside unification. That's another way to put it, but you got the point. And diversification benefits vanish in crashes. 2008 great financial crisis and the 2020 coronavirus crash showed rising correlations. We're just going to show a chart real quick. All right. But diversification remains a cornerstone for portfolio construction in the industry today. All right. We all do that. So here is an illustration of how a correlation with bonds and gold during the 2008 great financial crisis and the coronavirus crash in 2020, how it just jumped, all right, and tended very positively to one. Okay. All right. So what are the assets that are most negatively correlated with the S&P 500? Well, one of them is long volatility products, tends to be very negative, but very few people use them because it adds other types of risks in it, and it's more complex. So, for the average client of a advisor, it's kind of hard to make the case for them to use this kind of products. And for people who are not familiar with those products. Um, U.S. Treasuries, this is classic, right? Historically has been good, but we saw periods in which they were not. All right, so there were moments like 2022 with inflations. We got a problem, right? It turned very positive. Gold, as we just saw, kind of small, Put options, of course, this on the S&P 500 and inverse equity ETFs, of course, those are by design, right? They're going short the S&P 500. If they're going short, it's going to be negative, or so my -1 actually, right? So anyway, um, and also other things like managed futures, trend following CTAs. Okay, very few people use those, but it's possible. You can make with those. All right. So let's see how it is between gold and bonds, right? Gold and bonds. Which one is better, right? So for bonds, in normal market conditions, a little positive, right? But still okay, and gold a little bit better. So it's kind of close, right? A tie between those two. During inflationary periods, bonds not very good, right? And gold is better. So the winner here is gold. During crisis periods, um, bonds, the correlation for bonds just spikes up, right? It's to very positive territory. And gold is pretty much stable. So gold wins here too. And diversification for long-term purposes, right? Bonds is low but not negative, and gold is very low to zero negative. So gold is actually a little better than bonds to work as a hedge to stocks. All right, if you want to build a portfolio that way. All right, but that's not all. Okay, we have another problem. Is that the diversified portfolio potential returns are dampened because when you are adding a lower return asset to your portfolio, of course, the overall net return is going to go down, right? The stock return is greater than the bond return. The stock risk is greater than the bond risk. But when you add bonds to stocks, to hedge stocks during downturns, you're assuming that the correlation holds. What you're going to have is you're going to have the net portfolio return is going to be smaller than the stock return if you had 100% stocks instead of having 60% stocks and 40% bonds, right? So you're sacrificing stock returns for safety, right? You're adding a hedge here, and the hedge costs money. So you're pretty much sacrificing stock returns for safety. All right. So that's a cost. Let's take a look, in practice, right? So there's these two funds here are 60-40 funds. They try to it's a mix of 60% stocks and 40% bonds, right? So what are their returns, right? About 8.8, 8.1. And if you compare with the S&P 500 index, they're smaller, right? Which is expected because you have 40% bonds in it, right? So long term, even with the periods where you hedge, um, because the S&P 500 will go down during bear markets, right? And here you're gonna also um, face the same crashes, right? The same, but it ends up with a lower return, which means that probably the cost of hedging was greater than the hedge that it provided. All right. Okay. Um, so adding bonds lowers returns, but it introduces more stability, right? It moves out the ride. But the problem is that when you most need it, it may break down, right? That relationship may break down, right? So this is an example that happened, 2022. The S&P 500 went down 18%. The 60/40 fund went down 16.9. It helped. It did help, but it didn't really hedge the way we intended for it to work. Okay. So yeah, here's another illustration: 60/40 portfolio, and the S&P 500 is straight. Okay, so return sacrificed regardless of encountering a stock market crash or not, right? So even if there's no, let's assume that during a period you didn't have any crash, stock market crash or bear market, you still are you're still paying for the cost of hedging, right? So it's like constant hedging. All right. Okay. This is the all-weather portfolio, right? Um, the difference is that we have only 30% stocks, but we have a lot of different things: treasury bonds, commodities, and gold. Okay. So what's been the performance here? So all-weather portfolio generated an average annual return of 8.6% over the past several decades in the U.S. From 1996 to 2020, it has an average annual return of 9.7, which is significantly higher than the S&P 500 average annual return of 7.6 for the same periods. It's not bad, okay? But when compared to ours, we can do a lot better than that, okay? And then I'm going to show you why this is the case. So a solution to the correlation diversification problem. Let me just introduce real quick for those who haven't seen this before. The context-dependent dynamic asset allocation versus the static portfolios based on diversification. So what do I mean by this, right? I call these portfolios static because they don't change. They keep the allocation fixed for a period of time. Maybe they will rebalance on an annual basis or whatever date that is stipulated by the portfolio manager, but they don't react to changes in the market. So, but if we do a dynamic asset allocation, meaning that we are going to look at the context and change accordingly, that we will create a different way of doing this. It's just like there's a name for this. This is tactical investing, right? So we are going to tactically adjust the portfolio and not keep it constant with diversified assets in your portfolio. Okay, so let's show you real quick how this works. So basically, this is how it works, right? So if you're you have the traditional 60-40, for example, right? You're allocating that way. You'll have 60-40, 60-40, 60-40, regardless if you're in a bull market or bear market. Okay, so when you're in a bull market, stocks are going to do great, but bonds not so much, right? But when you're in the bear market, stocks are doing great, are doing horribly, and bonds supposedly doing well, right? We saw that there were instances that won't, but let's assume correlation holds, and this is the way it works, right? So you're suboptimal at all times because you're always hedging something. So that's why this you have a not the best return you could have, right? But at the same time, it helps you with the downturns. Okay, but with the context dependent dynamic asset allocation, what we're gonna do is we're gonna change the allocation according to the market regime. So if we're in a bull market, we're gonna go 100% stocks, and when it's bear market, we're gonna go 100% bonds. And the RISP 500 indicator is going to orchestrate the rotation. It's going to tell us what's the best moment to rotate from stocks to bonds, right? If we are using this too, I'm assuming we're using the same pair here, but in fact, instead of making a breakdown, we're going to change over time. So the goal is to match best performing asset to each risk environment. All right. So we know that stocks perform great in bull markets, right? And stocks perform poorly in bear market. That's by definition, right? So in that case, we're not going to hold stocks in a bear market. That's the idea, roughly speaking. All right. And there's no correlation required. So we don't need to know about correlation, if they're going to hold, they're going to be constant, or they're going to 10 to 1 or whatever. Doesn't matter. We don't even use correlation here. Okay. The diversification, yes, there's a diversification here. We're diversifying between stocks and bonds, but it's in time. It's in a different dimension. All right, the time dimension. All right. I hope this is clear. Okay, so I've been testing 8 strategies, using um, this concept. So basically, we're gonna in high risk environments, we're gonna hold cash. In low risk environments, we're gonna hold a risk asset, right? So safe asset and risk asset, right? So we're gonna rotate between them. Strategy one to five, only 2 levels of risk, the high and low, right? And we have a cutoff rate here, okay? Um, and and here, strategy 6, 7, and 8, we have 3 levels. It's a little bit more granular, and we have 2 levels to set up our rotation. So, for example, this one here, strategy 6, is we have gold, the S&P 500, and the S&P 500 times 2, right? So if we're very low risk environments, we are gonna be bolder investing in something even riskier. So it's like twice the S&P 500. All right. So that's the logic. Okay. So just a um, a analogy. Uh, from here we have a static portfolio based on diversification. Is like you're trying to face all different types of weather with a combination of, you know, um, here in this case, like weather, real weather, right? You're using clothes for a sunny day, but at the same time you have an umbrella, but this umbrella is very small, right? And you're trying to face, the weather this way, right? It's just like here, right? You don't know if you're gonna encounter a bull market or bear market, so you got a little bit of stocks, a little bit of bonds, and see what happens, right? That's pretty much what this guy is doing. Um, Whereas when you have a dynamic portfolio that's adjusted for the environment, it's just like you're wearing adequate clothing for each type of weather, right? Sunny day, it's appropriate weather, clothing, right? And so on and so forth. Okay, so that's the difference. All right. So here, just real quick, just so you can see, we have the RISP 500, the risk indicator on top, and the S&P 500 on the bottom, right? The SPY ETF. So in 2022, we had a bear market, most bear market. 2023, we had a year of recovery. 2024 was a bull market, et cetera, et cetera. So every time, in my case, my RPT, which is the cutoff percentile, risk percentile, I chose 75 because I'm a moderate investor. I'm not too aggressive. I'm not too conservative. A conservative investor would choose a lower RPT. Aggressive investors would choose a higher RPT, like 80% or even 90%. So in my case, what happens is that every time the risk 500, the risk indicator goes above 75 percentile, for me, it's a sell signal because this risk is too high for me, right? That's based on my own risk tolerance. So this is uh, customizable to each investor, right? So each investor has a different risk tolerance, so they can use different RPTs, so they can control better what they do here. So when the indicator crosses the 75 percentile line down, on the way down, I know now it's uh, within my risk tolerance, so I will buy back. So that's why this areas, this pink areas, mean that I'm out of the market. Okay, in this case, it's strategy one. Strategy one is S&P 500 or cash. So that means that all in during the periods that I have the pink areas, I'm not invested. I'm in cash, basically. All right. I think the most important thing for people to realize is that this is not a crystal ball. I'm not trying to predict or forecast what's going to happen with the market. right? Because the crystal ball doesn't exist. But what we're doing here is just assessing risk. Okay, if the risk is too high, it's above my tolerance level, I will get out of it. That's it, right? When the risk is within my risk tolerance level, I will hold it. Okay, so an important consequence of this is if you're just here in the market, you're not. Let's say you're not seeing any of the indicator, right? You're just in the market. You'll see ups and downs, right? So, for example, during this period here in 2023, you'll see ups and downs, but you don't know when it turned down here. You don't know if it's dangerous or or it's harmless, right? Because most of the time here it turned out it was harmless, right? It went down but then went right back up. And someone who has the indicator will have a better confidence that's okay, because if you look at the risk that the indicator measure, it's way below the 75th percentile. uh, it is his own risk tolerance, so that's fine. Okay, so he's okay, so this is harmless. Whereas if you're here, you're gonna signal that, wait a second, this may potentially develop into something more harmful. Okay, so that's I think is the contribution that the RISP 500 indicator gives you. And as a consequence, it works as a market timing device. All right, it wasn't built for that, but this was actually a consequence of using it. The the entire RISP 500 project was made to avoid crashes. That's the primary objective. But using it, we can see that it can be used as a market timing device. Okay. All right. This is just to show real quick what happened in the in the Liberation Day. It was very very recent. What happened, right? So right before we, few days before, we got a sell signal here. If you are at 75 percentile, of course. If you're at higher, probably you're going to hold a little longer, and then you're going to leave the market a little later, but still in time to be out of the April 2nd Liberation Day crash that we had here, right? And then at this moment, it crosses that line again, so we bought back. So okay, so basically that helped us avoid uh, the risk that happened during this time. Some people ask me why you didn't get back to the market over here, right? So you could take advantage of this upside. Well, my answer is, well, this is not designed to be a crystal ball to, yeah, and to make money all the time, for try to catch all the waves in the market, right? This is to avoid risk, excessive risk, right? Because this could have gone the other way. It could have easily gone further down. Okay, so this is something that I think is important for people to realize. Right? Sometimes people will ask me, "Well, yeah, you lost this upside here." Yes, I did lose this upside here, right? But that was by design. Okay. All right. So um, when we're judging performance, we shouldn't only look at the performance, right? At the returns, the cumulative returns. We have to look at the risk and also the maximum drawdowns that we experienced along the way, right? So, for example, here during this period from 2022 to July 2nd, just now. So the maximum drawdown during the period was 25%, and the cumulative return was 30%. It's almost 1 to 1. Okay, so 1.2. The ROMAD is the return over maximum drawdown, is this divided by this, right? So it's almost like 1 to 1. I'm making one to with the possibility of losing one, right? It's not a great thing. Sometimes people that do passive investing, like they're investing in the index, and they think they're playing it safe. But even though the S&P 500 is fully diversified, very diversified, you have 500 stocks in it, there is still the the systematic risk, right? All you did with diversification is that you reduced, perhaps to zero or close to it, the non-systematic risk, right? But the systematic risk still remains. So that's why you have this kind of drawdowns. Okay, the goal is to have this number the lowest possible. Okay, the ROMAD has to be the lowest possible. All right. So as we can see here, strategy 7, based on 3 levels for Nasdaq, we have a ROMAD which is much more efficient, almost 10 times more efficient than just holding the S&P 500. Okay, and this is all thanks to the context dependent dynamic asset allocation. All right, we're rotating between 3 assets, based on the guided by the risk that we measure. All right. Okay, yeah. So this is just an illustration from we started on the 1st of January 2022. This one goes to May 15. You see the S&P 500. All, pretty much all the strategies, long term, they are beating the S&P 500. Okay, and if we compare this to hedge fund results, you can see that for this is 2024. Our results for 2024 is here, right? We got from almost all the strategies except the volatility ones. We outperformed the S&P 500, and if we compare with this, we're pretty much at the top of the list. Okay. All right. So basically, the most important thing is, where's the proof, right? Where's the proof? The proof is the most important thing, right? Because I can be here talking for hours, but what does that really mean, right? So it's like you got to see it. So in order for you to see it, I'm posting this every single day. Okay, night to be honest, right? So to be exact, because after the market closed, I will calculate the performance, and I will put here exactly what I did for each of these strategies. What was the indicator that I used? So every single day. And the most important thing is why I post on social media is because there's a date and time stamp there. Okay, so that proves that I did post that day and that time. Right, so I can't mess up with the numbers after it's posted. All right. So that concludes the first part. To talk about the topic of the day, uh, correlation and diversification. Let's now move to market view, a brief commentary about what's going on in the market right now. All right. So the question that a lot of people are asking is why the S&P 500 keeps going up, right? Despite the Fed holding rates, um, even under extreme pressure from Donald Trump, and long-term rates are rising. We have the tariffs uncertainty, potential stagflation. There's a lot of talk about stagflation. If this is going to happen, I don't know, but the chance is not zero. There's geopolitical risks, etc. There's a lot of things going on, and many people start to think, to question why the S&P 500 keeps going up, right? Keeps going up. This makes me remember the period during which we had a similar thing during the 2020 coronavirus crash, where if you look at the fundamentals, it's pretty bad. I remember there were people talking about, well, there's no good asset to invest right now, and still the markets kept going up and up and up, right? So one thing is this: the M2 money supply just increased like crazy. All right. So this goes opposite to quantitative tightening. This is equivalent to quantitative easing because you have more money in the system. Okay, so we're at record liquidity, and it's the fastest growth since 2022. It's 4.4% year over year. We have increased deposits at banks and lending activity as well. We have 7 trillion sitting in money market funds, short term, highly liquid, can be deployed at any moment. All right. That's one of the reasons that Powell cannot cut rates too quickly. Donald Trump wants him to cut 100 basis points, but he can't do that. Otherwise, M2 will explode. It's going to be even worse. So what's holding a little bit is the rates that is still at the higher point, right? And this excessive liquidity flows into assets, and asset prices go up, right? If you look at the Fed's balance sheet, it reached the highest point, right? And then it started going down, 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 down. So when this Fed's balance sheet's going down, the liquidity is sent to the market, to the system. All right, we have a lot of money around chasing assets. All right. Okay. So if you look at where this money is going, it seems like across asset allocation across households, people, funds, and foreign investors is pretty much equities. All right, it's going into equities. Um, Retail investors bought a record 40 billion in April. A lot of people doing buy the dips here. Okay, so a lot of money channeled into equities. These people that trade based on volatility. We saw the volatility going down. If you're following the RISP 500 indicator, you notice that in recent weeks, the volatility just crashed down, right? So this is a signal for a lot of people to go long equities. All right. This may be a coincidence or whatever. It doesn't really fit very much the narrative today, but I just wanted to show real quick, um, just by comparison, right? 2019, 2020, and now 2025. We just, quick recovery, very quick recovery in both cases. As I said earlier, in 2020, we had here a lot of liquidity being injected in the system through the stimulus, right? The various stimulus that the Biden government had, just sent money to everyone, right? Even I got money from that, all right? So again, there's a lot of liquidity. All right. So what's the situation from now on, right? Today we just got the ADP, right? Not very encouraging. We're seeing that job cut announcements are on the way up, and tomorrow we'll have not tomorrow, yeah, tomorrow we'll have the payroll number, but ADP is usually a number that comes before, a day before, or 2 days before, so we can have quite an idea. They don't match. They don't match exactly, but the ADP, it just comes a little earlier. You see, there's a lagging effect um, for non-farm payrolls that will follow it, right? So this is not a very good sign for the economy. Okay, this is another thing. It's about the debt. Uh, this is very concerning because there's a huge amount of debt, like 9 trillion is gonna either mature or need to be refinanced. Okay, uh, this is so significant because it's like 25% of the total debt set to mature. And when? This year. Okay, that's the real reason rates are rising. Okay. If we look back a little bit, right, the debt, the U.S. debt, went up 23 trillion since 2008. We had lots of quantitative easing, and that money went through the system. And since the pandemic, we added another 13 trillion of debt. All right. And this is reflecting, of course, on the 10-year bond yield. Since the Fed started cutting rates in September last year, um, we've seen the uh, the, the 10-year grow 110 basis points. Now it's at 70 basis points. All right. And we'll have also a problem because many companies are indebted. They got when we you know when we had lower interest rates, a lot of even before, I think, during the pandemic, a lot of companies borrowed, and those that is coming due. All right, it's coming due. So this is just comparing the small caps in the Russell 2000 with the large caps in S&P 500. There's a reason why small caps are not doing so well, right? Because they have a big amount of debt, 832 billion, and 75% is going to mature or needs refinancing 2026, 2027, and 2028. By comparison, S&P 500 companies only have 50% of that debt coming due at the same time. All right. And meanwhile, there's another information here from Kobayas' letter. 42% of Russell 2000 companies are unprofitable, and the index is still 16% below its all-time high. Okay, so, but there's another thing that I'm watching, and I think you should watch too, is the high yield corporate debt spreads. All right. During Liberation Day, we got a little worried that this thing could spike out of control, but it didn't. It really came down. But we have to be watching. Okay. All right. So now, what's the market? What the market's betting on the next Fed actions on rates, even under pressure from the president. Jerome Powell is like holding it, right? So the market thinks that the July meeting, probably 74% probability that's going to hold, not going to cut here so soon. But the markets is betting that's going to cut 25 basis points in September, October, and December, right? So by year end, 75 basis points. And next year is probably going to hold at the beginning. So this is the profile of the rate cuts estimated by the market. Okay, there's not only an estimate. Okay, this is real market here, right? There's people betting money on it. All right, so better believe it. Okay. Okay. Lastly, about the U.S. dollar, right? So U.S. dollar has been under pressure, a lot of pressure, especially from the liberation date onwards. Now we are reaching a possible death cross. Death cross is when the 50-day moving average is gonna cross and go below the 200-day moving average. This happened before, right? But this is the opposite. This is not the death cross, it's the opposite. It's called the golden cross, right? And we had a huge upward move for the US dollar, and here too, right? But now it may signal something bad. But the problem is that if the rate get cut, which they will, eventually they will, and they may sink the dollar even more. Okay, so this we got to be watching this as well, because this will have consequences for the internal economy of the US. All right. Okay, so in summary, the scenario is far trickier than suggested by the stock market at the moment, right? The growing U.S. debt concerns are fueling bond yields and demand for treasuries, and we're seeing also demand from for treasuries from foreign central banks is going down, on the way down. Not good. U.S. dollar weakness caused by tariff effects, central bank independence, etc. Um, if the short-term rates are cut, dollar may go even lower. Liquidity is fueling asset prices, especially stock prices. And we have to think beyond fundamentals. If there are a number of other factors that we are not seeing, sometimes we know, sometimes we don't know, behind the scenes. And that's why sometimes we can't explain why the market is behaving such a way, because there are other factors out there. All right. Sometimes we don't even know them. In this case, as the liquidity in the market. Okay. But with the risk 500 risk indicator, all these factors would be priced in and to help you navigate the market. You don't even need to know all this, right? Actually, because then when I think it's very helpful for people that are not professional investors. Um, they don't need to know all that, any of that, if they don't want to. If they just follow the indicator will pretty much show the way. But it's good to know. I think we have to know. In my opinion, I think every one of us we should know, right? But um, if you don't have the time, etc., you're busy this week, you missed something here, no problem. The indicator is going to show you the way. All right. Okay. So this concludes. I just wanted to just go over real quick about the benefits of becoming a club member. Right. You have special access to the RISP 500 indicator to help you detect, time the market, detect and avoid market crashes early, beat the S&P 500 every year, and try to, truly accelerate your wealth. Okay. Um, we're going to be offering soon courses, challenges, and workshops. Those are some of them. You can take a look later after with the recording um, for more details. All right, we'll have more stuff coming up here. Okay, so this is another courses, challenges, and workshops. Some of them will be very short, to accommodate people busy schedules. All right. This this just want to conclude with something funny here, but I know that there's some people that are following the RISP 500, but is for some reason is a kind of afraid to use it. Right? If you have a solution that's you're not using it because you're not sure. That's why we're having these meetings, so I can demystify a little bit, and so you guys can understand what it is really about. Right? It's not a crystal ball. It's a risk management tool, and but which turns out to help you outperform the S&P 500. But actually it is a risk management tool. You can use it even if you're not 100% confident. No problem, you can use it with a small portion of your portfolio, right? You can even buy one stock or one ETF, and that's it. You don't have to spend a lot of money, but you can try it out. Okay, as you learn more and more, I'm sure you're going to find it more useful, um, okay, over time. All right, and you say, well, this thing is going to really help me or not, right? Then you can compare with other strategies that you use or whatever um, method that you use. You don't need to apply to your entire portfolio, right? But you can start over small, and you can see it for yourself. All right. Okay, so just a quick disclaimer here. This is more general information, educational purposes only. All right, no financial or investment advice of any type. All right. Okay, so this concludes, and I thank you for your participation here today. And if you have any questions, please don't hesitate to send me email, and maybe next time when we meet, I'll address those questions. All right. So that's it. And I wish you a good night and a great long holiday weekend, especially for folks here in the US. All right. Okay. Have a good night. Thank you so much. Bye now. Bye bye.